talk about some of the common myths and misunderstandings that exist around home equity conversion mortgage loans, commonly known as reverse mortgages or HECMs. It's unfortunate that these misconceptions persist because they hold back many ideal candidates from even considering a reverse mortgage. We've all heard that reverse mortgages are too expensive. The truth is that while a reverse mortgage may be more expensive in closing costs than a traditional mortgage, they may provide you with far more options than a traditional mortgage, such as no monthly mortgage payments and a credit line with a growth option that gives you greater borrowing capacity as you get older. The biggest expense is often the mortgage insurance premium, but that's the feature that ensures you'll never owe more than your house is worth and guarantees that you can live in your home until you're at least 150. Another common misperception is that your home will be taken away by the lender when you pass away. This is also not true. The house is in your name, and you or your heirs make the decision to sell or pay off the mortgage balance. If the mortgage balance is too high, your payoff is limited to the value of the house, and the remaining amount is paid by the FHA Mortgage Insurance Fund. If your heirs want to keep the home, they can either pay off the mortgage balance or obtain a payoff of just 95% of the current value of the home. Some people think that their house has to be paid off or debt-free to qualify for a reverse mortgage, when in fact, many people actually use a HECM to pay off their current mortgage, provided the reverse mortgage proceeds are sufficient to pay off the loan balance. So, you can go from having to make a monthly mortgage payment to having your mortgage payment be zero and completely optional. You just have to live in the house as your primary residence and maintain the home, pay home expenses such as taxes and insurance, and as long as all the loan terms are met, you'll own the home and remain on the title. The deed always stays in your name, and you have all the rights that you do now. You can keep it, sell it, remodel it, keep any equity that's left when you move, or your heirs can keep the remaining equity if you pass away. Lastly, you'll never need to worry about your children getting stuck with a big mortgage debt. Your children or your estate can never be liable for any amount over the value of the home because FHA's Mutual Mortgage Insurance Fund pays for those losses. You are always protected, and that is why the mortgage insurance is so valuable.